Hello, my name is Dr. George Mochocki, and welcome to Introduction to Business Corporations. You're taking me on a series of a variety of different chapters. This is an overview course in understanding basic business principles. Today we'll be discussing chapter seven. Will be chapter seven, understanding basic accounting. Now, you're either taking me at an online class or face-to-face class at a community college that I teach. I teach at both College of Lake County and Lake County, or Harbor College in northern part of Cook County. So look me up if you like this thing. Remember, just a summarization. We've discussed these terms and concepts in our lectures or discussion boards. You've already utilized integrated software that comes with the publisher's textbook. So we're doing pretty good on that. So now this is just after you already had access to my mind maps, and now you're just going to put this all together and say, do I really understand? This is a summarization, just to put together any kind of loose parts. I'll go through all the things. Sometimes I'm going a little bit faster, sometimes a little slower. Don't worry, remember, just a recording. You can stop me, play back, see what the concept map does, follow along the book, and you'll do well. Okay? And you need this for your feasibility project that you'll be working on in the class with me. Okay, so let's talk about what is accounting. And remember, the next chapter is going to be finance. So right now, we're just going to talk about accounting. We're talking about different accounting systems. What is managerial accounting? What is auditing? How to read an annual report? Public versus private ownership when we're talking about with stocks. What's the difference between bookkeeping? What are some financial statements that are very important? What's the balance sheet? What's the cash flow? What's an income statement? Those are your three most important financial statements. If you look at that, you could get a good general financial understanding of where the organization is, what parts of the organization needed tweaking, what parts are running well, and what parts are financially uh, going the wrong direction. Okay, so let's go on here. Now I'm going to make this a little bit bigger. Remember, open up your concept map, and those of you who had me, you write in. You always had a second tier. Uh, the more you listen to me, you use you write it. You even speak it out while you're writing it. The more senses you involve, the higher probability that it'll leave from short-term memory into your long-term memory. So you utilize this as you need it. Now, if you look at this chapter here, most of you will be taking some accounting classes or some financial classes. As you go into business, remember, the language of business is accounting. You have to know the dollars. You have to know what costs what. You have to know the inputs and how much you're going to charge customers. You have to know your labor costs. You have to know your supply costs. You have to know your expense side, especially when you can't change anything on the price side and you're not adding any value and you have competition in there. So the expense side, you have to be very frugal and you have to be able to focus on that. So let me open this up. I think 300. Remember, we'll expand this. I got it at 150. Let's go 300 and maybe too big. Okay, we'll see how this works. Okay, so now accounting. What's accounting? Now accounting, when I look at accounting and bookkeeping, we're getting into bookkeeping and accounting. It's kind of tied in, sort of together. One is just taking the information in, and then accounting takes that information in and looks at it as to analyze and come up with ratios of different kind of reports. So someone from a financial or other managers could look at the numbers and say, hey, here's what we have to change because it's not going on track. It's costing us too much money. Or we're making a lot of money. Maybe this is we should more invest in this aspect. So it's going to look at recording information coming in. It classifies it, different journals, different expenses, because you need that for your taxes, and you need that also for your operating expenses. How much money is per individual item I'm producing? It summarizes that. All the data doesn't do anything else unless you summarize it. And interpreting financial events, transactions in the organization, provide interested parties needed financial information. Okay, now when I look at accounting, is also very important for outside parties. Employees, when you say you can't give them a raise, or they look at how much the company's making, their profits. Hey, we want a part of that profit. We're the one that are producing, working hard, and you should reward your employees. If you got happy employees, you have a more productive and cost-effective workforce. And then you have your owners or your stockholders. They're looking at it to see, hey, it's a return on my investment. I invested in this. I could have did another business. I invested in this. How much is it going? It could, remember, in stocks, it could be also just growing the business or dividends. That's after profits. We'll get into that later on when we go into the financial statements. Okay, creditors, unions, investors, the government. Everyone wants to know how you know, always looking at your books. Okay, now language of business is, we need to understand that. Can't hire out to do, you could hire out this if you want. Don't tell your accountant you have no clue about accounting, because those are just like open up the door. Just take advantage. Here's the checkbook, walk away. I have an understanding of accounting. I understand accounting principles. I know where the money's at. I just don't have the time to put it all in the different reports. So I've hired you. So a lot of businesses, you know, if you do a small business, uh, you could hire out. But you know, what normally the recommendation would be, you hire out an accountant that does your day-to-day operation using QuickBooks or whatever software. I think QuickBooks is probably the one that's most universal out there. It's easy to use, and it has a progression to Peachtree. When your business grows, it has more functionality. But so you can hire someone else for every day, but then hire another accountant to do the year-end books. Even this accountant that you have every day, say, hey, don't you like me? Don't you do this? Trust me, I will do for whatever reason. I says, you know, it'll save you money. This guy's got to learn it. The second accountant that you hire a year-end book, he or she may charge a little bit more, but it's like a check and balance to make sure the first one is doing everything appropriately and looking out for your best interests. Okay? Now, the importance of accounting, as we have in here, is cost control. The more I can control the expense side, I don't want to squeeze. I want to utilize every dollar I can to its maximum effectiveness and efficiency. That's the whole core of being business and management. That means I have higher profit. If I reduce my cost and my price is stable, I can either lower my costs, sell more, or I have a higher profit margin because I reduce my expenses. Cash flow analysis equal adequate liquidity. Okay, now accounting system. I look at accounting system. You're going to look at inputs, processing, outputs, integrity. I'm just going to go right to the chart. No, sorry, wrong chart. Let me just go this way. What are inputs? Sales documents, purchasing documents, payroll, all expensive. Anything you're going to put into accounting, anything that is does anything with the business, anything that I'm spending for the business, anytime any money is transacted, anytime any kind of event is happening that the business should either pay out or hopefully charge someone for their services, I should have it done, recorded immediately. And it does the processing. You enter into journals, then are transferred into ledgers. Journals are like everyday things, and then you put it into your monthly or weekly journal, or in this case, it'd be your ledgers, your monthly ledgers. Finalize, summarize, and review to compile a trial balance. And all trial balances to make sure when we talk later on in the balance sheet is that everything is working well, that there's no glitches, that the numbers are taking, and it looks that we're on track. Okay. Then when I look at the outputs, I develop financial statements, and we're going to talk about the three main ones. You know, income, balance sheet, and cash flow. Just get used to them. I'm going to be telling it over so you do well on the exam. Balanced cash flow, and for management and outside company. Integrity is generally accepted accounting principles. When students take, even myself, when I've taken accounting classes, sometimes it drives you nuts because it's so rigid. Remember, I'm a manager and a marketing individual, so I'm very flexible, very fluid. That's what you have to be, those attributes you need for those skills, because everything's always changing. But it's so rigid. But it has to be rigid, because if I'm looking at the books and the income statement or the balance sheet or the cash flow of one company versus another company, I'm not talking about the ratios, the numbers would be different, but I'm looking at, I know exactly the same components were involved in that, and they didn't I don't say cook the books, but manipulate it, put something in there, make the numbers or the ratios look well, because that's why it has to be so rigid. So take it, do the courses, do rigid, but when you're doing the finance and you start trying to change those ratio numbers, you need to understand what's went into those numbers, okay? And then so you've got that, so it's generally accepted accounting principles, outline procedures that are accepted in the field. Now you got what went wrong, Enron, Fannie Mae, and WorldCom. What went wrong is their accounting became, later on the author does a nice job when we talk about the editing side of accounting, the auditing side of accounting, and the managerial accounting, the consulting side, for lack of better words, okay? There was more money in the consulting side, so there was pressure placed on the editing side, and the auditing side to be more creative. So there were like assets that showed in a book that were indicated in the section that showed as fixed assets that were actually there, but in reality there were future contemplated sites with very little down payment or something, and they kind of stretched what the rules was of owning an asset in a nutshell. But that's, so you could read into that. So anyway, so now you have a generally accepted accounting principle. You have to follow those procedures. Okay, now this one is accounting responsibilities. Cash management, inflow and outflow, forecasting, market strategy and planning, personal financial planning. You help your employees. Valuation, what's the value of the company, merger, acquisitions, and taxing audit. And now some accountants will do it all, but a lot of them are very specialist in one field or the other, which works out well. Does they know? Hopefully, know anything about it. Okay, now managerial accounting. Now managerial accounting. This is where the money's at. Provides information analysis to managers inside the organization to assist them in decision making. Which processes are losing money? Which processes are bleeding, for lack of a better word? We're putting money into it, and our return is really low. It's like poor energy efficient. Look at the old cars. You used to put, for 1 gallon, you'd get maybe 10 miles. Now 1 gallon, it could 40, 50 miles. Depending on the size and everything else, but when you look at it, wow, that's really efficient. So your inputs and outputs, right? So this is what it's telling you. Some of these areas, you're spending more to keep the operation going than the operation's worth, and you're not making any money. Time to cut it, or improve it, or find a way to cut on the expense side. Okay, so managerial accounting is involved with preparation and controls of budget. It lets you know which areas. Look at the expense side. Cost of production. So they are, a lot of times they're managerial because they also may have an engineering background or a background in a different discipline, so they understand the true costs. Okay, cost of marketing. How do I get more? People aren't going to come to my shop or buy my shop. Sometimes I got to create a market or remind a market that we are a viable product or service, and we are very cost effective of what we do, and minimizing tax liabilities. Okay. The next one we're going to do users of accounting information. Okay, so users who uses accounting information, and here's a whole chart. We could go through all this, but let's see if the chart makes it. So I have everything on the chart, so I don't have to kick it. I did it on a mind map in case you print it out. So government taxing authorities, tax returns, internal revenue, you need that. Government regulatory required reports for certain chemicals or processes you're doing. People interested in organizations' income and financial position, owners, creditors, suppliers, financial analysts, financial statements found in annual reports. These are the 3 main ones. There's a lot of them. The main ones: income statement, balance sheet, and cash flow. Managers of the firm, financial statement, and various internally distributed apps. Okay, so read that. That was pretty good. So and that's all that thing was. It basically had everything I did on the chart. I just put it on the mind map. Okay, all right. Okay, now financial accounting. So now you got managerial accounting. Managerial accounting is coming out there, and it's finding a way to reduce the waste, or finding a way that you are running effectively, or changing the process flow. And it's looking at the expense side and reduces that. And a lot of times when you have the consultants coming in there, they understand your process and they'll cut it. And for a fee, so you benchmark. Here's how much we were, and after they finish with the process innovation, here's how much we saved. And a lot of times you'll pay them a percentage of the savings plus a lump fee. But in the long run, you're running a more effective business, happier customers, happier employees, and you're not wasting anything. It's happy for the environment, everything else. So all that you go right into the marketing. Because of our process improvement, we're environmentally safe. We reduce our footprint by so much because we combine and we are working more effectively and efficiently. Okay, now so financial accounting is a little bit different. Financial accounting, if I look at that, they look at the company and they give financial information and analysis that are generated for people primary outside the organization. So if you're looking at it when you talk to people outside, you, I don't want to say embellish and enhance, but you prepare the thing so it puts the organization in a good limelight for the investors and the creditors, depending on the message. Remember, from the marketing, the messages you're trying to convey, and that's all placed in there. As for example, for you're no longer paying on account dividends because you're taking the profits and you're retaining that earnings so you could expand your operation. But if you don't communicate that to your stockholders, your creditors, they're going to think, oh, the company's something going on there, and they start selling. So the annual report is a nice way of saying, here's what's going to happen in the next 6 months. We apologize, but as the growth of the company gets stronger, we'll be able to pay more dividends. Outside users interested in what? Is the organization profitable? Is it able to pay its bills? Right? How much debt does it owe? And the annual report, a yearly statement of financial conditions, progresses, and expectations for the firm. So because of new regulations coming in, by next year, as I can see it going down, I can inform my shareholders, hey, we're going to be struggling. It's going to be very tight. Don't expect any dividends for about 1 or 2 years till we compensate or improve our efficiency in our end and still meet requirements of the environmental or EPA protection agency. Okay? All right. So now the CPA on this is Certified Public Accountant. Okay, so now let's look at this one. We're going to look reading the annual report. Manager's decisions. When you look at the annual report, you look at manager's decisions and analysis of operations. Sorry, it's a little bit late at night. I'm live. Those who know, I'm live. I'm not reading off the script kind of in here. So just like in the classroom, only no students asking questions. But I kind of assume I already done this long enough to figure what questions you would be asking. So I try to address it indirectly or directly. The book is always there, your integrated software. So you kind of remember, we're at the end of the chapter. So this is just summarizing. So you can look at the balance sheet, the income statement, the cash flow, and the auditor's opinion. Now, when I look at this for annual report, that's what they talk about, the balance sheet, how much we owe, it's our owners, or company's equity, owner's equity, what's income, how much revenue is coming in, what's my expenses, how much cash we have in hand. And usually this is done with the annual report. It's also done with an auditor, an outside auditor that I have to pay, but they come in there and they audit my thing. Now, they'll give me a qualified, unqualified, which basically means nothing's wrong. They'll tell me a qualified 1 or 2 irregularities. Customer could or could not, cannot change. Adverse, serious, did not follow the general accounting practice. You had issues there. And after that, usually government comes in afterwards. Disclaimer, unwilling to make an opinion. Remember, I'm just telling you the numbers. Here's the facts. Here's how I weigh that probability. You make the decision. You go in there. That's what the auditor says. But this is what I'm coming out here, and I'm just going to give these classifications where this organization financially stands, and let the stockholders take it. If I tell you one thing and you go belly up next thing, then I get sued at, for lack of better words. Okay, public versus private. Private accountants work in a single firm, government agency, nonprofit organization. We'll talk a little bit later on that. Public accountants, individuals or business. Private, they work in a single firm. Public, individuals or businesses. I'm out there for whoever was able to pay for my fees. Okay? Now, CPA, Certified Public Accountant, meets state's requirements for education and experience. After you finish that, then if you're doing any kind of books or anything else, you could add on to it. Remember, you must meet the state's requirement for education. A lot of students will come in, or a lot of people going for the CPA exam. Look, some people got their master's and their PhD and can't pass the CPA exam. It's not an easy exam. It's a very difficult exam. So they have to have education. You have to have so many business courses. It doesn't have to be accounting, so you understand that. And because remember, you're a public accountant, you have to understand different processes, different businesses, even though they're found the general accounting procedures, but different businesses may operate differently. And how do I make sure I put in the right journal or ledger? Okay, accountants who have passed a series of examinations established by the Illinois Institute of Certified Public Accountants, could be both in private or in public. Okay, now the Dodd-Frank Act, all the stuff with the housing crunches, the banking closing, all that stuff. So Wall Street reform and consumer protection came in here. That's what this act did. That's why there's such a high demand for accountants, because even a small business that has a certain, let's say up to about 15 or more employees, if I'm mistaken, has to follow the same procedures. And so a lot of business owners say, man, this is tedious, this is a lot of work, I've only got a small business, I will not cripple the whole economy. But the government, when it goes from one side, it'll basically come back. So there's a good demand for accounting. If accounting is an area you would like to go into, there's courses in there for the next 5-6 years. It's a very favorable trend. Could be longer than that, but I'm saying you always need to know where the cash is going. Even if we become a payless society, you still have to know what to charge, the units or credits that we will be receiving. So okay, so ACT was a public company accounting oversight. ACT was brought on by recent financial crisis. And this is just really quickly for next thing, finance. I'm looking at finance, and this is for next chapter. Something like got thrown in here, but I'll leave it. I'll leave it in here so it'll make sense. So, just a general thing. Finance, a little different than accounting, and I'll explain that in our next chapter when we talk strictly on finance. Responsible for acquiring funds and managing the funds. And the one thing you have to look for finance is important, undercapitalization, insufficient startup fund. And that's only not even for startup businesses, but also a lot of businesses may not have the additional capital even when they're going into another market, and then they have like a domino effect. And I just will just kind of throw this in the general idea. So remember, accounting comes up with the numbers, the report, the analysis. Finance, chief financial officer, what we'll be covering next chapter. The person in charge of finance will be the one that'll say, hey, we should buy this, we do this, and in accounting, you look at the numbers again and says, yes, we are on the right course, because now the numbers are making the directions are going, reducing expenses, and our profitability is going up. That's what you want to hear. Okay, and then we talked about auditing. So auditing, basically reviewing and evaluating information used to prepare the company's financial statement. Look, I'm an investor, a stockholder. How will I look at what's in there? I have to have an independent auditor that gives us this review statements that we talked before. He just lists us which areas that he says there's no problems with, and then I still have to make that determination what I want to be with that company. But I know somebody there went into the books, actually looked at the process, and it's there. These are reality, and I'm happy, or I pull my money out, or I get more involved and see what the company is doing to rectify any negative, or is it going to stay on course if it's doing well with profitability. Okay, so it's an independent audit, an evaluation, unbiased opinion from the outside about accuracy of the company's financial statement, certified internal auditors, accountants who have a bachelor's degree, 2 years of experience in internal auditing, they're specialists on this, pass an exam administered by the Internal Institute of Internal Auditors, and here's the link if you want to look at it. I won't do it today. It will be, I want to keep these underneath an hour, and probably will. If I have time, I may come back, okay? Okay, now there's other specialized accountants. Remember, we haven't even gotten into any of the different forms. I want you to understand we're coming up from a large global. Here's the work, here's what they do, and then we're going to come down to actually to the financial statements. So we're building this up. Understand what their work is. Understand their mindset. What do? They think a little differently. If I look at accountants, they have to be detailed. They have to understand the processes, but they're very focused. And if you're, and even if you're your own business, a lot of times the accountant just making sure the numbers are there, but you have to understand the same thing because you're the one that's creating the numbers and putting that the input, so you can find out what the output is. Are you working effectively, efficiently, in utilizing your assets effectively? You got two cars, you only need one car. You never use the other car, sell it and use that money to either pay off debt or something else. Okay, specialized accountants. When we look at specialized accountant, we have one that only does with taxes, which is good. Because if you have a tax accountant, he or she should know the tax code inside and out to minimize my tax obligation. I love the government. I want to minimize the tax account. Trained in tax law, okay, and are responsible for preparing tax returns or developing tax strategies as to minimize the tax rate legally. Okay, government and nonprofit accounting, a little different. We had the good Will videotape. You'll be looking, discussing it in our classroom or in the forums. Support for organizations whose purpose is not generating a profit, but serving others according to a duly appropriate, what do you call it, budget. Okay, so what else we got? Now we have the accounting cycle. Here's the accounting cycle. 6-step procedure that result in preparations. Now I got the chart of accounting cycle. Let's talk about analyzing the documents, take trial balance, prepare. So let's look at this one. I got a lot of words. I kind of like the charts, the picture. Okay. Analyze the source of sales strip. That's the first thing. I get the paperwork. What do I got? Like you do. Look, you do a lot of this stuff now. If you're not in business or you're in business and now you're going to be a team leader or a department head, or you're going to open up your own business, or you're going to move up in the middle manager, you have to understand. So you're analyzing, what am I being billed for? What the heck? I don't really see this chart. I don't remember being there. And you got to take care of it. Record transactions into journals, so you're writing it down daily. Here's what's happening. Transfer the journals to the ledger. And a lot of times if you do it online using a debit card, it does it for you. Take a trial balance to make sure what I have in there is actually works out. Prepare financial statements, and they're talking right here: balance sheet, income statement, and statement of cash flow, and analyze financial statement. Now I haven't done anything, but I'll let you look at these just so you see. You see, prepare financial statement. We had there. Take a trial balance. This one here, source, sales. So for some of them I have it, but you have everything you need right here. Okay. All right, let me just see now. They're not doing too bad. Okay, now let's look at bookkeeping. Bookkeeping is part of accounting. A main part is the basic core. Bookkeeping is the skeleton of accounting. I need the bookkeeping. I need the paperwork. I need someone to put it down and actually write the numbers down so I can analyze it. So what is bookkeeping? Bookkeeping, recording of business transactions. Divide a firm's transactions. This is sales. This is, and when I'm talking about transaction, it's people buying, me paying, me getting stuff, me doing other stuff, into meaningful categories, and post them into a record book or computer called a journal. So if I'm looking at your checking account, let's try back to those of you who have, most of us got a checking account, and you could see how to pay your bills. It always says, what category do you want? Is it for medical? Is it for education? Is it for food? Is it for a lifestyle? Something to enjoy yourself with? So when you look at it, and then after a while you say, hey, I can't keep up my bill, and you look at where's most of my money going? If it's lifestyle and I enjoy that, but I'm not paying the other bills, I got to cut on lifestyle. Is it medical? I may not have a choice, but maybe I have to find a different medical provider or something. So remember, it's just put in a category. That's what bookkeeping does. Now, when they talk about double entry in book, is bookkeepers record all transactions in one place. So I paid a bill, so cash came out, right? But then I also got service for that, so so I got something in to offset that. You see what I mean? So I have two entries that tie each other together. Okay. Now ledger is various journals, various categories, a specialized accounting book. Where, let's see what I have here. I wrote it in, forgot. or a program where all information is one place. That's all it is when I'm talking about ledger. Here's the book. And now it'd be on the computer file or the mainframe someplace. Trial balance, figure balances, summary of all information in the account. The recording of business transactions, that's all journals are. Each day transactions, and then transactions, buying and selling supplies. Okay, that's just so if I look at, boy, geez, we got a lot to go here. I better move along. All right. Okay, financial statements. Let's talk about the financial statements that we need. Financial statements are a summary of financial transactions. I need and life makes it easy. And you've got financial statements now. Most people now are either using a debit card or a credit card, vice versa. If you're using a debit card or credit card just for security reasons, it's fine. Most of you will have the chip now. But when I'm using the debit card, credit card, when I look at that, just don't look at the bill how much I owe. Look at that as a financial statement, a track record. In business, I use debit, credit card, so I have a paper trail, so I know which portion. I got documentation if I'm challenged or requested by the government or the creditor, supplier, or whatever reason I have that. Okay. Now, key financial statements of a business are, what do you think? Balance sheet, income statement, and cash flow. Okay, so and we'll have all those up in here in a second. Foundational accounting equation. Here's the formula. Remember this. You go to accounting, please say remember this. Assets equals liability plus owner's equity. If I turn in owner's equity, equals asset plus liability. Okay, are you all right? Look at the equation. This is the equation. Assets, what I have, equals my liabilities, what I owe somebody, and I actually have that asset. That's the formula. Okay, so let's look at a balance sheet. Now, balance sheet, I'll give you a quick definition. What a company owns, or owes, tongue twister, on a specific date. Okay, so that's a balance sheet. So it tells me what I owe, right, on a specific, or what I own, or what or who I owe for that asset on a specific date. So it looks at assets, and it always looks at assets listed in order of liquidity. Most liquid first. So if I asked you what is the most liquid asset you have, cash. Well, you could probably go debit card because the same thing is cash in there. Okay, credit card a little different because you got to pay somebody else off. Okay, so economic resources owned by a firm. Items can be tangible or intangible. When you look at SBC, Southern Bell Communication used to be our phone provider here in Illinois, and then all of a sudden they merged with AT&T. They brought AT&T out not only for the equipment and everything else, a little more in line. They brought them out for the name. The name was worth more than anything else than what AT&T was at that time, because the name AT&T people knew globally. There were international name recognition. When they used SBC, they came up with Southern Baptist Convention, and if you're just looking, it didn't make sense. So AT&T was a good investment. Plus they got property and they got a good chunk of the territory. Okay. All right, so you got assets, so right? Now liquidity, ease to convert assets, convert to cash, and it goes down in the order. Then you got current assets, convertible in 1 year. You have fixed assets, we take that as long-term assets, relatively permanent, like land, buildings, or equipment. Let's see, tangible assets, fixed assets. Okay. Now, if I got intangible assets, long-term assets that have no physical form but do have value as patent, trademark, we had that. Okay, now what about liabilities? Again, part of the assets, I own the car. It's my car, but I have payments on it. It's my machinery. It's my asset, but I have a liability against it. That's where, remember, that's where the balance sheet sees is on both sides. Should be balanced. Balance sheet. Okay. All right. Now, debt or obligations owned, expenses, and that's rents, salaries, accounts payable, credit limit liabilities of a firm owes for merchandise or services purchased on credit, notes payable, short-term or long-term liabilities like a credit card, Okay, business promises to pay by a certain date. Bonds payable. Okay, just IOUs, corporate bonds we're talking about. Long-term liabilities the firm must pay back. And then that gives me my owner's equity. Owner's equity is what? Assets equals liability plus owner's equity. Retained earnings. Retained earnings. Accumulated earnings from a firm's profitable operations that are reinvested in the business. Okay? That was a lot on the balance sheet. Come on. Look how much you did. I know, look, we covered. Remember, we worked all the way up. This is the summarization, so you know where you're getting at. But these are the ones you have to do. So know a balance sheet. So that's why I said if I look at any three financial statements, if I know those three, I have a good idea what the company's doing. Now, accounts of income statement. Now, accounts of income statement. What's an income statement? Your paycheck. An income statement is your revenues, your sales coming in. Financial statement shows the firm's bottom line, that is profit after costs, expenses, and taxes. This is what I made, okay? Net income or net loss is revenue left over or depleted. The statement of revenue is another statement. Oh, sorry. Okay? Move this over. We're live, so I forgot to do that. Statement of revenue and expenses. Here's the formula. Revenue minus cost of goods sold. You're going to be doing a real short what do you call income statement in my class and a quick balance statement. I won't do a cash flow. It'll be good enough for because you got my online, my face-to-face class. That'll work out well. Minus cost of goods sold equals gross profit. Gross, not net yet. Operating expense, I subtract that, equals net income after taxes minus the taxes equals net income and net loss. And so what are my revenues? Is monetary value firm receives for goods sold, services rendered or other payments. The next one I need is cost of goods sold, cost of merchandise the firm sells, or the cost of raw materials, supplies, if used to producing the items for resale. Okay, then we have gross profit or gross margins, how much a firm earned by buying or making, selling merchandise. And we got operating expenses, costs involved in operating the business, such as rent, sales, and supplies. And then we have depreciation. When I look at depreciation, depreciation is an economic term, a systematic write-off cost of a tangible item, asset over an estimated use of time. And the rationale, if I had a piece of equipment and it kept on running, and I never want to replace it, why would it? There's no incentive. So right now I have a piece of equipment, I could write it off to a depreciation, usually 5 or 10 years if I do accelerate it. And now I can't write it off anymore, so then I have to weigh, accounting has to look at it, my tax accounting. Should I buy another piece of equipment and improve my productivity? Plus, I have another tax write-off because I could depreciate this piece of equipment. So in the long run, I'm better off in investing in new equipment, and because it helps my productivity and also helps my bottom line. But remember, you don't have to sell the equipment after you depreciate it all off. You just can't write it off on taxes anymore. You don't have a tax write-off. Okay. What do we got? Oh, pretty good. Okay, now value inventory. You have two things when you look at the inventory. And then when you go in accounting, it'll make a little more sense. I just want to say you have FIFO, you have first in, first out, LIFO, last in, first out. And the inventory, the accounting procedure allows you to go one way or the other. It gives you the flexibility. Do I use the raw material because I got a lot of raw material and use the price of the raw material I paid for, cost of goods, we talked about it, but now I have a higher cost for the finished product for whatever reason, but so I'll have a larger profit margin, which is good if I'm looking at a business or whatever. Or I could use the last in, first out, and the last in, so now the cost of the resources is higher, and my other cost for the product is still competitive, so I don't have as high of a profit margin, so I have a lower profit return on investment, and that may help me off, because if I have a higher return on investment, it may put me in another tax bracket category, which will be a higher percentage, so just by tweaking a little, I could stay underneath until I'm ready to jump. I want to grow, but when I grow, I want to jump, not just at the end, just by a few units, be paying the higher tax. I want to be already in there. Come on, got to pay. Might as well make the production out of it. Maybe productive, effective. Okay, first in, first out. That's what FIFO stands for. Higher profits, older, less equipment. LIFO, for lack of better words, last in, first out. Lower profits, more recent goods, or more expensive. Generally accepted accounting principles. Method for accounting. Sometimes limits ability to use different. Sometimes limits the ability to use different method of accounting inventory. Oh, there we go. Accounting sometimes permits accounting to use different method of accounting inventory. I just had them flip. When I'm looking at that, I'm going, it doesn't flow right. All right, remember I'm live. We're good now. Okay, yeah, each evaluation can affect income by ending the inventory valuation. Remember, it's what I paid for it, and when I actually sell it, the cost of goods, it goes out, then I have to claim it. Okay, now cash flow statements. Let's look at the cash flow. Statement of cash flows. Reports cash receipts and distributions related to three major activities: operations, investments, and financing. So if I look at cash flows, I mean, I gotta pay, I gotta bring it in, investments, my operating, run a business, and financing, how to get goods or services, or fix things, or buy new equipment, or venture into a new area. I gotta finance a new project. Okay, so cash flows. Let me just move this over a little. The difference between cash coming in and cash going in, the flow. Trying to make it up a little bit here. Okay, so if I'm looking at managing cash flow as a key consideration of a business, can be particularly challenging for small business, seasonal businesses. Look, if I'm only selling Christmas trees, I'm just throwing up because the holiday's coming up, okay? I'm selling Christmas trees. What do I do the rest of the year? I may be growing Christmas trees and selling as a nursery, little trees, those that can't sell, and I already took them out of the ground. Doesn't make sense to put them in and then take them out later on, or they're not doing well. I may just plant them in and say chop down your own Christmas tree, or have something else. So the Christmas trees I'm getting ready around July. I already got to get the Christmas trees dyed and everything else are green in July for the summer season when I start selling them. So may have a cash flow if I don't know how to manage it. What am I doing to bring streams of income coming in? You know what I mean? So that type of business is seasonal. Is very it's got to be careful and got to be very creative and very aware of every penny that's that you actually do stick to your budget. Okay. Now, ability to pay is on time. So if you're not doing your cash flow right, remember when we talked about the personal, they look when you go for a loan, they look at your bank checking account, and they just want to see your cash flow. Do you have money? If you're here, you got paid Thursday, and they say you got the big check coming Thursday, and by Saturday you're only down to $10, they know you have a cash flow problem because you don't get paid for another 2 weeks. Okay. All right. Now, the last one we have here are ratios. Now, when I look at ratios, these are the main ones. You're going to have a ratio, just two numbers of different things, but these are the main ones. When I look at ratio analysis, you have to compare the company with the same industry. And when we talk about activity ratios like inventory, and I'll just go into that now before I forget. If I look at inventory turnover, and that's what you understand, when you're looking at ratios, you have to compare apples to apples. If I'm looking at inventory turnover, how quick an inventory, how many turns an inventory turns over in a month. So I'm a car dealer. I'm not going to see, I may have my inventory may turn over maybe 1 or 2 turns, depending on how many cars I sell. Because it's a very high expense item. Okay, or realtors get slower turnaround. If you have more, that's good. It means your business is really booming. But normally, and that's a car one, I'm consistent with the rest of the other auto or car dealership turning inventory over. I take that 1 or 2 turns, and now I am Mariano's or Jewel Foods in the produce or the meat department. If I have a 1 or 2 turnover a month of my inventory, I got a lot of old, outdated meat. So the ratios there should be more like about 20 or 30 a month. I'm turning over the meat fast, so it's always fresh, right? So do you see what I'm talking about? So the turnover, the ratio, but what's my turnover ratio at Mariano's Jewel compared to other stores, other grocery stores, even Walmart, just their, not the whole Walmart, but just the grocery section when I get their turnover. That's how, and I'm looking at what my competitors are doing, and I could see how they're doing it also. Okay, so now the ratio analysis. If I look at the ratio analysis, the assessment of a firm's financial conditions using calculations and financial ratios developed from the firm's financial statements. That's a good sentence to remember. You compare other firms in the same industries. We just talked about that earlier when I talked about the car dealers, the turn of inventory versus a produce store in terms of inventory. Okay, or what they call sell-through. Okay, liquidity ratios. If I look like liquidity ratios or current ratios, or pay bills on time, ability to pay short-term debts, divide current assets by current liabilities. This information is found on the firm's balance sheet. Okay, and an asset that is a real shorter version to do it real quickly of the current ratio, how much you have on hand. Leverage ratio is measures the degree to which a firm extended debt used to run the business relies on borrowed funds to run its operations. Extent debt used to run the business. Okay, debt to owners' equity ratios. This information found on the firm's balance sheet. So all of these are found on the firm's balance sheet. Okay, so now you know the measures of degree the firm uses debt to pay its operations or business, now how much it owes, and now you look at the profitability. The one I'm interested in, profitability measures what? How effectively a firm's managers are using the firm's various resources to achieve profits. Some of the key ratios for the profitability would be basic earnings per share, return on my equity, anything I put money into it, return on my sales, how much of I'm selling it, am I making money on the goods I'm selling? I should be. After my advertising and my distribution and everything I had to do with it. That's what they call the yield. Everything that aspect with sales after it's all done. Am I making money? Am I selling the right product? Do I have the right sizes and goods? Okay, found in the balance sheet again. Okay, now some activity ratios. Activity ratios, it means something that's very active. Effectiveness of an asset, how effectively manager is turning over an inventory. And this one will be inventory turnover, speed of moving inventory out. Okay? I think I hit all the ratios. Geez, I really did good today. All right, class. Let me just bring this all down. Expand to level 1, and we bring this down to what do we have? 150 we saw before. 150 was. Alright, so we covered a lot today. This is just an introduction to basic understanding of accounting. The next chapter we're going to be talking understanding finance, how accounting takes this information and how it plans and how it has to acquire, looking at debt, financing an operation that we talked about here, or bringing new product, or bringing in what do you call capital equity sources of income or cash into the business. We looked at ratios. We looked at cash flows. It's very important because if you don't pay your bills on time, it hurts your credit score. It goes up. So most business fail because of poor cash flow. We looked at income statement, how much I'm making, and remember the income statement, you do it monthly, it comes up. The same thing with the balance sheet. So you always check in, wait till the year end and find out, oops, I messed up. You always keeping it as a living document going forward. Fundamental accounting equation, assets equals liabilities equals owner's equity. Financial statements, the three main ones you have to remember: income statement, balance sheet, and okay, now bookkeeping. Remember what bookkeeping is? The actual putting in the information coming in, sales report, and categorizing them and actually put them into the right statement. Accounting will take that data, analyze it, and make sure it's in the right journal. First of all, it was categorized right in the right journal, and then it transforms into the ledger which is basically my accounting software, for lack of better words. Different specialized accounting, public versus private, what did Dodd and Frank Act do, finance, a little bit about that, auditing, why is that important, in the accounting system. So we covered everything else again. So we go into the finance next week. So you're doing well. We're almost done. I think we have finance next week. We have banking, and I think investment. I think 3 more chapters, if I'm not mistaken, because we already did personal finance. So remember, keep up on your homework. You're doing well. We should be finished, and then next week we'll be starting finance. My name is Dr. George Mochocki. You're taking me either on an online class or face-to-face class at a community college. If you're looking at this at YouTube, gives you a general idea about the class and the program. Your community college is a strong, most effective source of learning, professional growth for a lot of businesses. So if you can't go to one of the schools I'm teaching at, find your local community college. You're already paying taxes for it in the community, and they will be very specialized to address the issue in that geographic community that they operate in. Again, so my name is Dr. George Mochocki. I'll see you next week in finance. Bye.